Good morning, good afternoon, depending wherever you are. Welcome to our Allianz webinar here from Munich. I'm still in Munich. My name is Martin Zschech. I'm the Global Head of Industry Solutions and Client Management at Allianz Global Corporate and Specialty. I'm also responsible for the financial services industry. And so why are we here today? The reason was when we saw what was happening in the world in early March, especially in the US. In the banking sector, we saw Silicon Valley Bank collapse, also Signature and Silvergate followed. Not long after, we had just over a weekend in Switzerland, Credit Suisse, the agreement that Credit Suisse will be taken over by UBS. We have seen massive outflows from regional banks in the US of deposits. Just this morning, I read on the Financial Times that First Republican Bank, a Californian lender, they had 100 billion outflows this year. So it's very clear there is a lack of confidence in the system. So that's why we thought it's the right time to give you a macro view on what's going on in the banking sector, what's maybe coming next, where are we at, and also what are the risks for the economy overall. And so that's why I'm very glad to have our Chief Economist of the Allianz Group with us, Ludovic Subran. He leads our economic research team at Allianz SE and also Allianz Trade. Prior to Allianz, he worked for the French Ministry of Finance, United Nations, the World Bank. So I think very well, or I don't think, I know very well suited to give us a good view on what's happening. Before I hand over to him, just a few housekeeping rules. So the total webinar is set for 1 hour. That means until the full hour. That means CEE time until 11 a.m. We do very much encourage you to ask questions. We'd like to make it very interactive, but you're all muted. So you can't unmute yourself and ask a question. You have to use the chat function. So please feel free to add all questions you might have into the chat functions. I will then read them out to Ludovic and ask them on your behalf. Yeah, I think that's pretty much it. With no further ado, I'll hand over to you, Ludovic. Thank you.
Thank you so much, Martin, and good day to all of you. I think I will try to summarize a bit my view on the situation in maybe 5 messages, and then the idea would be to have a conversation. The first thing is to try to understand the broader picture. I think the financial stress didn't necessarily start with the Silicon Valley Bank failure or the Credit Suisse weekend. I think the type of interest rate shock that went through the economy in 2022 has been visible in a series of economic segments. So a lot of people have been talking about canaries in the coal mine. A lot of people have been talking about a theory which is called Minsky-Kindleberger clock, which is this idea that you have the antechamber of a financial crisis. I think it's very important to keep in mind that, for me, we have seen several financial accidents before the banking sector crisis in the US, the mini banking crisis, and we will continue to see financial accidents. I can trace back to what happened to Greensill and Archegos and reverse factoring, what happened to commodity traders, margin calls, what happened also to a certain extent to the pension funds in the UK, which has been very, very important to understand also what is the role that the authorities want to play in solving this. So for me, the situation is something that has been there for quite some time. Of course, the climax was the banking crisis in the US, because it's the banking crisis, it's the banking sector. The banking sector is special because it's systemic, it plays a function, and it is, as Martin mentioned, the epitome of trust. But I don't think we're done. If you look at the Global Financial Stability Report of the IMF, you see that they're getting concerned about non-bank financial intermediaries. I believe that there are, and I will come to that in a moment, still some risks in the banking sector in the US. And last but not least, I also think that we have some specific actors that have not been necessarily behaving the right way. And I will come to what I think is one of the most important points to keep in mind. Everybody is obsessed with true cash and liquidity. And so just this behavior is a self-fulfilling prophecy for more financial accidents. So the first message is it's a financial accident, which is, a bit a story told, chronicles of murders foretold, because it is something that happens always when you have the type of tightening that you've seen, 500 basis points in the US, 300 basis points in Europe. You have, want it or not, a very different environment than just a year and a half ago, and certainly a different environment compared to the past 7 years in Europe, for example. But in the US, the shock to interest rates is quite massive. So there has been financial accidents. There will continue to be financial accidents. The banking crisis that we've seen is one of them, and maybe the most newsworthy, but I don't think it's over. Look at hedge funds, pension funds, look at buy now, pay later, a series of non-necessarily very well regulated actors can also be thirsty for cash and true liquidity, and in an environment where unrealized losses from the bond market could actually hit them in the back, which is very important. So that's the first element. The second message I want to say is what is fascinating in the UK with the pension fund, in the US with the banking crisis, and in Switzerland with Credit Suisse is the policy response, which is something that has surprised me, has surprised a lot of the people. Why? Because it's been really a massive bazooka. So we have a confirmation, if we didn't want to see it in the eye, that no policymaker is ready to have yet another financial crisis. And so they're ready to save the financial institutions, whatever it takes, even if it's saving billionaires. We can look at Silicon Valley Bank story the way we want it. We can tell ourselves a good story, but it's a billionaire's bank run. With, I'm sure the justice will show a lot of crooks in the making. People calling themselves over the weekend to withdraw cash. That doesn't sound very legit to me. But what we know is that in the 10 first bank accounts of Silicon Valley Bank, there was $13 billion. So it looks like a billionaire bank run to me. And yet, the response by the federal government has been to bail them out fully, which was a major surprise. So, but it is a confirmation somehow that, policymakers are ready to do whatever it takes to save financial institutions, even if the amount for taxpayers is huge, and even though the action is extremely skewed to the very wealthy. Was the same with the pension fund in the UK. It was the same with Credit Suisse. So you see a very massive, determined policy response to circumscribe and to bail out. And for me, this is something we have rarely called out for what it is, which is a new way of thinking capitalism. For me, capitalism is you make profits, great. You make losses, great. We have a new way of doing capitalism, which is you make profits, great for you. You make losses, not so great for the taxpayers. and this is very important to understand, right? So first thing is, we have seen financial accidents. We will see financial accidents. This is a changing environment of interest rates. There's going to be something to the tune of, cost of credit and so forth. Second, the policymakers are very ready to act, right? Third thing is risk management, and to a certain extent, what this crisis has shown in terms of risk management. I hear a lot of people saying, it's the US fault. Trump has deregulated the banking sector in 2018. And so that explains why these banks have been doing crazy stuff. I disagree with that. I think if you work with the financial institutions, you should look into their risk management practices. So of course, now it's, hindsight is always 2020. So it's very easy now to say, oh yes, they really mismanaged their duration risk, and they had 130 billion of unhedged long bond maturity on their balance sheet. And of course, with what just happened, the valuation of this bond portfolio has plummeted. And yes, they couldn't pay whatever need for deposits they had at one point. It's not, I don't like people that are rewriting history and telling you what should have happened because they know better after the fact. But one thing is sure is, in an environment of higher interest rates and an environment after a pandemic and a war, and in the midst of a financial tightening cycle, unprecedented because of inflation, and financial stability concerns rise. And as a result, trust in your financial institution is very high. But trust in their risk management practices should be very high. What I mean is not because Trump is a culprit of many things, but it's not because he deregulated that these financial institutions shouldn't have behaved. And I think self-regulation is still a thing. If we bank on the regulator to solve it all, then that means the regulator, which is already always too late, will not do a great job at confirming the trust. It's up to every stakeholder to confirm the trust. We have to be activist consumers of our financial institutions. We need to look at their risk management practices, their liquidity management practices. We need to be aware that Signature Bank was not a bank, because cryptocurrencies are not a currency, nor an asset for the matter. And this was a bubble that was created by free money. The moment money is not free anymore, well, something that has absolutely zero intrinsic value shouldn't fly, and trees don't go to the sky. So for me, this is also a reminder that financial institutions, including, we need, as stakeholders, shareholders, partners, clients, to look back at the fundamentals of risk management. And the fundamentals of risk management are, there will always be shocks, there will always be hazards, but the only thing you can master and control is vulnerabilities. And for me, what is interesting now is to look at these vulnerabilities. And we can see vulnerabilities. We can see vulnerabilities in the regional banks in the US and their commercial real estate portfolio. I can tell you that right now, my main concern on the banking sector in the US is that they are obsessed with the number of people returning to the office, just because the loan portfolio in these regional banks in office space that are now being cut because there is a 30% less, caseload going to the office is a Faustian bargain. There is right there in the making a doom loop that someone needs to address, because it is going to be bad, of course, for people to keep empty offices for their own finances, especially when the cash burn is increasing. But it's also going to be bad for banks to see all these defaulting loan on commercial real estate. And I'm talking offices here, but you can also imagine that a lot of companies are also not really ready to pay rent. Right now, rent is indexed on inflation. So a lot of the commercial real estate on, especially on shops, is doing well. But remember that with inflation eroding margins and with purchasing power of people going down, there is less volume. And some of the retailers, for example, specialized retailers, are in bankruptcy gray zone. And of course, the famous one right now in the US is Bed Bath & Beyond. So this is what we should all do. We shouldn't focus on managing the risks, because I think this is a dream, but we should scan vulnerabilities and make sure we understand how leverage, which is a big issue in the asset management world, very leveraged asset managers that don't necessarily have the right cash entries and inflows to be able to repay their very costly leverage. Interconnectedness, does the problem of one create a problem for you? Currency risk, which is also an issue. Right now, we haven't seen really a lot of stress on the currency aspect, but that should be a problem. And then liquidity. How do you manage true cash? What do you consider liquidity or not, right? This is a vulnerability mapping we should assess all financial institutions, especially banks, through. And this is very true for the US. This is very true for banks and non-banks, but this, I think, could be applied anywhere. You see, for example, including in Europe, that maybe the risk on the banking sector is not that big because, we are, swimming in deposits, and we had our own, major, not little, banking crisis in 2012 to 2015. And so as a result, or I would say we had a banking crisis and then a sovereign debt crisis, and the two showed our doom loop on bank sovereign. And so we are now a bit cleaner than before, and most of our net position ratios have improved massively. There are still the stray cats here and there, but and maybe we are not as forceful as the US, the UK, or Switzerland if there is a problem in the euro area, for example. So we have our own vulnerabilities, but somehow we're a bit on the safer ground. Yet we still have some actors that need to be extra scrutinized right now, just because of, especially the point on liquidity or leverage in the asset management or even in the balance sheet savvy type of activities. So that leads me to the fourth point: liquidity. We have a problem, guys. Liquidity is one of the most used word of the financial system, and yet I think it's the least understood word of the financial system. So usually when someone says, oh, there is a liquidity premium or there is a liquidity risk, I often start by asking them, what do you mean by liquidity? And then it's like, it's a bit blank. Yeah? Liquidity means, as many things as people want it to be. There are 50 shades of liquidity if you want to be a bit into BDSM. So for me, what is happening right now is a market liquidity issue. It is maybe a funding liquidity issue. I like to separate liquidity into two types of liquidity to make it simple: stock of liquidity and then flow of liquidity. A stock of liquidity issue is what we see right now, meaning there is mechanically, because of price, but also because of volume, and I will come to this, there is less liquidity in the market. For example, the unwinding of balance sheet by central banks is creating a stock of liquidity problem. The behavior, the liquidity obsession of financial institutions now, as we speak, is creating an additional stress on the unwinding of the liquidity stock into the economy. We see it through monetary aggregates. We see it through, different measures of what the central banks are doing, of course, but also what the lending to the economy is showing, what financial institutions' new obsession with cash is creating as a form of self-fulfilling prophecy that there will be less and less liquidity right now because everybody is under PTSD of what happened to the banking crisis. So everybody now is looking at cash. Companies are looking at their working capital requirements. Banks, insurance companies are looking at their liquidity position and what is liquid assets, what is not liquidity assets. The banks, of course, are looking at their credit to deposits activities. Some of them are even thinking about separating those activities because they realize that maybe, there will be purely, deposit institutions that would be yielding 4%, and then there would be lending institution on the side. It is creating a real reshuffling of the stock of liquidity. And this is very important to understand because this is going to be, this for me is the major advice I can give to anybody, companies, financial institutions, is be liquidity obsessed for the next 12 months. Because of what I said before, there will be more financial accidents, because it is how you do vulnerability mapping, because it is going to be an obsession for everybody. And so as a consequence, other people's withdrawing the liquidity carpet under you could cause you to have more liquidity issues. And this is not going to stop. This may actually be not too bad for inflation because this is a vacuum cleaner of monetary supply after having seen, helicopter money. So maybe it will actually help soothe the inflationary pressures, but it can create a lot of domino effect and it can create a lot of bullwhip effect on the provision of liquidity in the economy. The last thing I would say on liquidity stock is, because everybody is going to become liquidity obsessed, we're going to run certainly into an economy that is suboptimal, where a lot of people are going to be sitting on tons of cash, not necessarily investing, maybe doing, dividends and share buyback. And I hope they don't do that because that would show not so much liquidity obsession, but certainly we go with, the less liquidity flows, the less banks do their role, the less financial institutions can match, the more the risk of zombification is to be kept right. This is the stock of liquidity problem. To be fair, it's not the first time, it's not the last time, it will happen again. I'm not that worried. What is worrying is if we have a flow of liquidity issue, a market freeze, a credit crunch, a financial market crisis. And to be fair, right now, the likelihood is not high, but it's not too low. That's so. For example, in our scenarios at Allianz, we have the risk of a financial crisis with different magnitude. We have a downside risk, I would say, which is in the realm of 20%, and then we have a real, GFC-like, which is less than 5%, and we model those. And when we model those, we realize that this liquidity flow crisis, this freeze, in the sense of a credit crunch, a crash, is of course much more nefarious than a liquidity stock issue, which is just a mismatch issue, which is creating a bit of tension. And so the idea is, can you ring fence against this, and can you do something preventively? Is it critical enough a scenario that you need to do something about it? The answer is, I'm not so sure. Why? Because if it really happens, nothing is liquid. So if anything happened on the tail end, I think whatever you've done to protect liquidity during this situation would be welcome action, but there will be no real mitigating action for a financial crisis, but to have, yet again, governments be the insurers of last resort, or the bailouters of last resort. And I think this is very important to understand. Right now, a lot of people are confusing the stock of liquidity crisis with the flow of liquidity crisis. I say, you have to sell off your private markets, you have to sell all your real estate. I think this would be stupid. I think if you are in long-term value creation, you stay in this portfolio positioning, and then you try to manage cash through cash. If there is, in any case, a global financial crisis, which I find to be very low in terms of likelihood, the solutions to that will have to be a new public-private partnership, just like we saw in 2008, 2009. So that's my first message. And then, Martin, I just want to finish, because I have this this fifth message, and then I know there are plenty of questions. I hope. And my fifth message. So liquidity flow, liquidity stock. My fifth message is, I mentioned a few issues that are concerning for me on the outlook, either doom loops or the way people should manage risk management, this obsession with liquidity and so forth. There is one thing that this banking crisis resuscitated something, and I mentioned it in passing, but for me, it's very important for everybody to understand. When I said that policymakers are ready to do whatever it takes, I believe that we're going to have a very difficult next 5 years to disentangle what is public action and private action, including for financial institutions. So I don't have a lot of time because Martin reconnected, but I call that war economics, or economics of war. I think we've been at war against the virus. I think we are clearly at war against Putin. We will be at war against climate change. And so that means more interventionism, more fragmentation, and somehow more inequalities. This secular thinking is somehow demonstrated in what I just said, which is when there is a crisis in the financial sector, there is no bail-in anymore. Shareholders are helped. You could say creditors have been squeezed, especially in the Credit Suisse time, but most of the time I would expect creditors to be saved, and we see that in a lot of the management of bankruptcies in the non-financial sectors recently. But it's very important to understand that we're going to have a major issue going forward for the financial sector that would create some form of the winners and losers, or casualties, or collateral damage, which is greening the financial sector, which is matching deposits with long-term financing needs to go onto net zero carbon pathways for the economy. The reason why I want to end with this is because one of the reasons behind the current financial accidents backdrop is, during COVID, we put a lot of money into the system and we created a lot more debt, a lot more inflation, and certainly a lot more financial risks into the system, right, to avoid bankruptcies, unemployment, and the long recession. I believe that some of these responses may be used again to fight climate change. We may need some debt monetization, we may need some rationing, and we may need some reallocation of capital to the effort of the war, this silent war. So what it means is there is not only one type of hazard coming to the financial sector, which is this interest rate massive shock. There will be more coming from the fight against climate and the necessity for the banking sector, for the financial institutions to play their role in transforming millions into billions to finance our decarbonization. And this will not be a walk in the park. So I think we need to keep in mind that as we green balance sheet as financial institutions, as the risk of stranded assets increase, as regulators and central banks want to play a role in greening with different collateral policy, different regulatory charges, I hope they will be playing more the market forces rather than the regulation and taxation forces or the policy enforcement forces. But I believe this is going to create yet another bumpy road for financial institutions, which are going to be looked through the lens of how brownish or how greenish their balance sheet is, how brownish or greenish their new lending is. And if you see what's happening in Europe, it's a bit less the case in the US, where there is an open debate on what is ESG and whether it's legal or not. You see that the jury is still out on how we're going to make it happen with a legacy financial sector and a pure player financial sector. And I believe this is something we need to keep in mind, because this will be a source of new financial accidents. You can call it fraud-like and Enron type. You can see maybe financial institution with high reputation risk, or you can imagine another form of purely financial endogenous risk for the financial institutions through their adaptation, if you will, to a greener world with potentially big impairments on their balance sheets from brown assets, but also from a lot more regulatory straitjackets to be able to do their role, which is again to match, people's savings to meet the financing needs for the green revolution, which are immense and exponential, as we know. So that would be my 5 topics, with the last one being, free as an advice on looking at green in the financial system as a new and upcoming risk for banks and financial institutions. With that, I will stop here, Martin, so that we can have a question and answer sessions with the attendees. Thank you very much.
Thank you, Ludovic. Now, so I didn't want to rush you. It's not like drowning questions. We have a few. I just thought there was one that would have, I thought that was fitting in well, because it was around the comment you made in the beginning around policymakers are willing to do whatever it takes. And I think you also used the famous from the German Chancellor, the bazooka, at least I know it from him, that they just cover any losses, whatever occurs. And the question was around, when did that change, or was it always there? When does this redevelop? Since 2008? That's kind of where this question is going.
It's a very good question. It depends on what is your magnifying lens on history. I believe we had a good ride when it comes to creating the conducive environment for capitalism in the past 20 years. So there has been some massive intervention in 2001. For me, that's the dot-com bubble is the first moment where I feel that the Fed is not the Fed that we agreed on to be inflation targeted and not doing debt monetization in the 70s, which is after, the the oil crisis, which is when we said, okay, we're going to separate the roles of central banks and the real economy so that they focus on price stability. The Fed has, of course, the second mandate since on jobs. And in Europe, we had, price stability, and then we had the form of unity of the euro. But I would say from 2000 to 2020, in spite of 2008, 2009, I would say that it was a good ride for touches here and there of policy interventions, but still the rules of the game were, some people will go up and down, and in 2008 and 9, even though we have the impression that central banks have done a lot, we still had a massive increase of unemployment, a massive wave of bankruptcy. So in 2001, and then in 2008 and 9, and then for the European Central Bank all the way into 2019, we had intervening central banks, but it was okay. Now, I think 2020 is a pivotal moment because we really decided not to have a repeat of 2008, 2009. And so as a result, we really threw as much money as we can into the system. And we completely killed, for example, the bond market. There was no private bond market. It was a liquidity freeze moment, but we decided to not have the same type of casualties that we had in 2008, 2009. And, it went very far with fiscal stimuli. And this is why it created a lot more debt, a lot more inflation, and a lot more inequalities, to be honest. So for me, the past 20 years, it was okay. I would say the 90s was also okay-ish. The 80s had a bit their time of normalization. So I could even say the last 40 years was a time where central banks were trying, after the oil shock, to do one job well. And now we are questioning again whether they can do it. That's, so I could say now it's a bit different from the past 20 years. I could even say it's a bit different from the past 40 years, even though, we are in a much more interconnected world. So the type of policy response don't stop at your border. The US dollar is the de facto currency, even though people are saying now that there is de-dollarization, there is no alternative. So the US dollar is still for now the de facto, safe haven. The president of France in the 70s used to say the exorbitant privilege of the dollar, which is basically that when there is a crisis, everybody rushes to the dollar. We saw that again, the past 3 years. That's how the dollar became so strong. And even if China de-dollarized to manage their currency better, not at the expense of the US, but that's for a different debate. So that's 40 years, right? But if I look at the bigger time frame, we always had this, post-war or in between wars attempts at distinguishing public and private, and then wars made public morph into private, and then they try to distinguish again. So this accordion is something that we've seen in the biggest history of times. That's usually, wars usually come with these spikes of inflation after a lot of debt monetization. So I would say, unfortunately, this type of moment where you have a Faustian bargain between public and private, where you have, policymakers overstaying their welcome and maybe over intervening, it's something we see almost, every 25 to 30 years, at least in the past 100 years. And it's usually after wars. So I'm not surprised. What is surprising this time is the world is much more interconnected and much more financialized. And so the responses are very financial and have a lot of international spillover compared to before. I think that's the big difference.
Thank you, Ludovic. I think that answered that question. I've just have one myself, because you talked about the economies of war and the big challenge for financial institutions to deal with the decarbonization. Can you think of a comparable event, like in history, like that posed a similar challenge for the financial industry?
But the financial industry is in a very specific state, right? There is no comparison with financial history before. But I think Hmm. Is there one single event? I'm not sure. I think wars are good comparisons because you have to reallocate capital to the effort of the war. This is what you see now with greening. You have to monetize debt, which is what we're going to see, to finance the need of the war. And you have some form of rationing, call it sobriety. You have to cut some of your emissions. You have to do something yourself. So the First World War, the Second World War, wars in general are unfortunately very good comparisons with this silent war of climate change. In the bigger history, I think you had certainly moments. For me, so now I'm going to go very far, but in time, not in the philosophical moment. But I think the fight against climate change has a feeling of renaissance to me. Renaissance from Gothic, architecture. You go to, this very open windows in the churches and so forth. Why? Because I have the impression we have to be very modest and humble, because we are seeing that just like a historical renaissance, empiricism or empirical evidence trumps dogma. Meaning, in the fight against climate, there are many more things that we don't know compared to things we don't know. And so we need to make us be a bit more climate literate and learn the things we don't know. And so we need to be driven by empirical evidence. What works, what doesn't work. The debate right now in Germany is water pumps. Do they work? Do they don't work? Should everybody have a heat pump or not a heat pump? So I don't think we have the answer. So for me, there is really a moment, and some people would even compare it with much more recent history, with Marxism. A lot of detractors of climate change policies say it's like a religion. This is the new communism, because a lot of people talks about changing your way of life and so forth. So you can project a lot of historical analogies to climate change. The ones that fit for me is we don't know so many things that we need to be driven by empirical evidence and not believe in dogma. And for me, this is a form of renaissance. So I see the positive of that. It has to come with technological innovation. It will be very bewildering for people who are used to the dogma of we fly this way, we heat that way, we produce electricity that way. So that's one comparison. And the other, as I said, is unfortunately, as an economist, I see a lot of comparisons with war times, because you have this triangle of issues that are very warlike, and including the one that I maybe spend the least amount of time discussing, which is inequalities. I believe we need a Churchill of climate change that explains to people that they're going to be winners and losers. It's not going to be everybody wins out of climate change. Things are going to be costlier. Things are going to be much more constrained. And so this is where I think we have this rationing of sobriety war moments that is not explained to people as we speak.
Okay, thank you. So certainly a big challenge. We've got another question coming in here, more around the events in the financial institution sector in the US and also Europe. What about Asia? Like, is it safe to assume that we are somewhat shielded from these risks? Is the questions in Asia?
I don't think so. I think I could give you countries where I'm a bit worried about not only financial institutions but also the way indebtedness has been managed. One country that comes to me is Malaysia. Malaysia is a very indebted country. Private households are very indebted, and so we need to keep in mind that there are some concerns about the way such an interest rate shock could become a leverage shock for a lot of private actors in Malaysia, be it households or corporates. I was just going to check we do plenty of publications, but we in particular have a weekly publication And in the last weekly publication, we looked particularly at the vulnerable banking sectors in emerging markets. So there is a full paragraph that looks at which emerging markets do we think are most at risk from, I would say, the financial vortex of the US super tightening, but also from their own issues about the way their financial institutions have been made more resilient in the past years, right? What happened, for example, to Adani, the conglomerate in India, or Abengoa in Brazil, that could be related to this financial accident series that I mentioned, right? Where you see, I think Turkey, Egypt, these are countries where you see unprecedented credit growth, which is creating a lot of issues for their balance of payment, which may end up in very strong devaluation of their currencies, which then will feed back into risks for the commercial real estate sector and the banking sector and so forth. So Turkey, for example, had a massive banking crisis in 2001. And since then, the banks got much stronger, but Turkey's current account deficit is crazy high and it's not getting better. And so, of course, there are some balance of payment crises that are visible in some of the emerging markets. So Pakistan is also, not that I think a lot of you guys are present in Pakistan, but when I look at Pakistan banking sector, I get a bit, concerned. And then in Southeast Asia, I mentioned Malaysia. I think Vietnam has done a lot to clean its banking sector because before it was a bit bubbly. And, there is clearly a USification of Vietnam to a certain extent, or at least it's a new battlefield between the US and China. I would say now it's not as visible as maybe 5 years ago, but for the longest time, I've been very concerned about the Hong Kong financial sector. Now it's a very different financial sector from 5 years ago because a lot of people have cashed out. A lot of investment banks and so forth are moving to Singapore. So the financial sector of Hong Kong is now very yuanified, renminbified. So the crises are a bit different. But maybe let me spend 1 minute on China. I think China is quite immune to the mayhem in the US banking sector, but if it gets much worse, nobody is really immune. But China has its own financial crisis in the making. One of the reasons why, for example, the reopening of China doesn't work is because China had the worst real estate crisis in recent history. Very similar to the Spanish real estate crisis of 2008, 2009, or to the Japanese real estate crisis of the 90s, Evergrande. We've seen that from afar because China was close to the eyes of the world. But to be fair, one of the reasons for the financial repression today in China and the absence of inflation is because there is an entire segment of the economy which is, collapsing, which has collapsed. And so the banks in China, and this is one of the major, when you think about how obsessed policymakers are with financial stability, the Chinese are obsessed with financial stability. For them, it's much more important than price stability. And so they have been trying to avoid at all costs. That's why also they've been very gradual with inflow of capital from foreigners. They've been trying to avoid at all costs a financial crisis. So the result is now that, of course, the banking, the lending channel is still highly planned. But the cost of credit is increasing, even though now they're trying to decrease it again so that they don't completely have a muted reopening. But there are financial risks everywhere. The leverages in the corporate sector. There are 3 countries in the world that have the highest leverage for the corporate sector right now, which is also something that could be triggering more concerns for financial institutions: the US, China, and France. This is where the corporate sector is very indebted for their own good, I would say. So for China, this corporate indebtedness is a big issue, and this is creating a doom loop, if you will, between the state, the corporate, and the banks. Just like in Europe, we had a doom loop between the state and the sovereign, the state and the banks, the sovereign and the banks. In China, you have this doom loop between the sovereign, the banks, and the corporates that is very strong. And so this could be another source of financial crisis for some of the Asian economies that are maybe more financed through China. And one of them, I just mentioned Vietnam, but you could think about Laos and Cambodia, some of the smaller Asian economies that are maybe less turned towards the international market.
While we're in that region, what about Australia?
Australia, of course, the Australian, the Bank of Australia also had to tighten massively because they had some imported inflation first, and then Australia has been on a streak of very strong growth. They have some issues with the financing of the commodity sector. They have some concerns, like a lot of countries, like Canada or like Sweden, or like the Netherlands, with housing. So I think their financial stability is very linked to their Dutch disease to a certain extent. Australia is a bimodal economy. They export commodities and services, financial and university services, which are the third and fourth largest exports after commodities and commodity processed. So I believe Australia has some domestic financial risks, clearly could be taken in the US vortex more than, say, Europe, to that matter. But again, the financial vortex of US would be also affecting Europe. I think there is this idea that if the banking crisis gets worse in the US, which is a likelihood, it will not get to Europe. It's not true. Australia would be one of the first to be affected just because of the interconnectedness between the US and the Australian financial market. But the biggest concern for me, for the Australian banking sector right now, is the housing market, because it's a very strong leverage borne by the local banks with the risk of default, right? I mean, one way to look at beyond what's happening, you mentioned this trust crisis, right? Or this fraud, to be fair, for SVB or Signature, maybe also for Credit Suisse. What is interesting when you look at the banking sector is profitability, which is not too bad for the banking sector in Australia. The NPL book, so the defaults. And for me, that's where there could be an issue, especially on mortgage defaults. And then you have the liquidity or, asset management type of issue, which is not bad.
Yeah. All right, we've got another one here. Are the recent events a catalyst to finalize the European Union banking union? Finally.
I hope. I wrote about that in the Frankfurter Allgemeine Zeitung. I said, let's not be complacent and let's finalize this banking union. But as you know, this is, the French and the Germans still have a go at it. I mean, this deposit insurance, there is still a lot to be done on reassuring, who is, which deposits are basically the insurance deposits for the wider banking union. And I think this is an act of faith somehow, because this is a leap of faith, because you need to see the banking sector in Europe as one, which is terribly difficult when you see how, Switzerland has managed its crisis. I remember how many people have been telling me, oh, look at Switzerland, they're doing things so well. Switzerland is not a very democratic country when it comes to handling the banking sector. They now have this mammoth, very badly managed, balance sheet, which represents several times the GDP of Switzerland. And they did that behind closed curtains. They squeezed out their AT1 bondholders. And are we ready to do the same as Europe? I don't think so. And so that's why the the banking union right now is very important to finalize, because if we have any event in Europe, we need to make sure we behave as one. But that's also why we are still hesitating, because can you explain to the German taxpayers that if there is a problem in an Italian banks, even with mismanagement or whatnot, and I take Germany and Italy, but it could be the other way around, looking at the profitability of the banking sector in both countries, can they understand that it's one monetary lake, one monetary union? I'm not sure, but I hope at least the Commission issued again a statement that they are very strongly working on it. I hope that this is exactly the type of event that creates an extra push to finalize, to complete some of the architectural issues that we have in Europe that would be essential for swift, determined, and efficient response if we have a form of banking issue.
Okay, we have another question. I'll read it out there. One is, your earlier statements alluded to the polarization between the interests of taxpayers and the billionaires club. Do you see this resulting in higher levels of consumer litigation against larger FIs, or will taxpayers punish via elections?
Both. Both. I think financial institutions are at very high risk of more activist customers. Yeah, big time. I think, and for good reasons, because financial institutions have a special status. They're not any type of capitalist object. Clearly, they are saved all the time. And so, if I were a customer / taxpayer / citizen, I would question how, for example, banks have been making so much profit over the past couple of years on the back of very strong indebtedness for the public sector. I don't want to replay the match, as we say, but during COVID, we decided to avoid an asset management crisis in March 2020. And we decided that the banking sector will be the weaponized arm of the supply of money, the creation of money. This was a massive transfer of wealth from the private to the public sector. And as a result, we have a lot more debt, public debt, and banks have been making profits, a lot of profits in 2020, 21, and 22 in Europe, for example, mostly because of TLTRO, so the targeted loan refinancing operation. So this is a bit undue profit, to be fair. So I think financial institutions should behave, because they have had a good ride on the back of future taxpayers' money. And on the other side, on the polls and the public opinions, yes, I think it's an issue. Because, of course, so I'm French, so, people take it to the streets before taking it to the ballots. But I can tell you that people are seeing the very strong linkages between governments and financial institutions. I think for good reasons, because they are special to the functioning of the economy. But of course, it is seen as a Faustian bargain. And of course, governments that have been in place during the management of the pandemic are now questioned in the efforts and maybe the doing that they did that have saved somehow wealth, or capital owners versus wage earners through financial markets functioning, or banking institutions and financial institutions running through the crisis with a bit of public money. And so, of course, they are seen as accomplices. And so that's why they have a very vested interest in making sure that the financial institutions do their job the best they can. And for example, I think that the way President Biden decided to step up to the banking crisis in the US is very telling for the Democratic camp on how some of these linkages between the Silicon Valley, I call that the San Francisco consensus, is not reassuring to the lefter wing of the Democratic Party. And I'm sure for the primaries, I mean, Biden thinks he has a go, but it's going to be very interesting to see how this is going to be instrumentalized by the Republican side, but also throughout the Democratic side to say, look, what have you done as a centrist Democratic president? You've decided to save banks and to save billionaires. I'm very surprised that this discussion is actually quite muted. We've heard the Elizabeth Warrens and the Alexandria Ocasio-Cortez of this world, but it could go much worse than this. And so that's a good warning sign for policymakers to understand what is the safety distance between them and the financial sector. That's for sure.
Okay, we've got 4 minutes left, so I think we can go for one more question. Do companies have enough equity to face non-insurable risks? It's maybe putting your trade hat on.
What is sure is that they may have, the company's net financial positions are actually quite good because of also this massive transfer of wealth. I think a lot of them have piled up a lot of debt, so we need to be very worried about those companies that are so-called zombie companies, so for whom their debt repayment is higher than their EBITDA, and there are many of those. So these are the ones that are most at risk. Generally, I think the equity position of companies is not too bad. Because most have had good pricing power right in 2021 and 22 because they are obsessed with cash by construction. The big question is you link that to the insurable risk. I believe self-insurance is making a comeback in many ways because people have seen that the big risk, the risk transfer through insurance doesn't work because we've seen exponential probabilities and systemic risk, a pandemic, a war, but I don't think this is sustainable. You cannot have more self-insurance and waiting for the insurer of last resort. We need to strengthen the middle muscle. So tailorized risk transfer proposals. How do you work your self-insurance prevention capacities through good advisory services by your insurer so that you keep some of the risk on your balance sheet depending on your equity and risk appetite? And how much do you transfer? I think this is the story of the next 5 years because risks are multifaceted, interconnected. So there is not one actor that can shoot it all. So I think, yes, some companies have stronger equity level to manage some of the risks. But I unfortunately think that we have a lot more interconnected risks that need some form of transfer. And so for me, this is how you massage and you stretch this middle muscle is by rethinking a bit this mapping of vulnerability. That's why I say I call for this come back to fundamentals of risk management and also what is defining your own risk appetite, I think, which is something that everybody needs to do, including financial institutions themselves. What is the right level of risk appetite and how do you drive and what are the determinants of your risk appetite? I used before working for the Allianz Group, I worked for Allianz Trade, which is really on the working capital financing. And I remember meeting so many CFOs and CEOs that, they didn't even know why they had a credit insurance policy or they had a receivables insurance policy because they thought that they would get some form of factoring, so they would never, they were thinking somehow that they were offloading some of their risks, right? Which is not what a credit insurance policy does. And I think that the risk awareness from the past 3 years is good for the sector because now we're talking real business because people understand what could have happened. They see the scarring effects of these big shocks and now they are looking at their risk transfer, in that case credit insurance or credit management practices much more granularly than they did in the past, where they're like, okay, I had a policy, but I don't really think, no world in their right mind will be closed for 3 months, or we will never have a war, 2 hours away from Europe. Of course, this happens. So, of course, it requires a mix of the 3 layers of the rocket, self-transferred and certainly a better public-private partnership.
All right, Ludovic, it just went to 11 a.m. I'm very impressed. Amazing timing. Thank you very much for that. Also, thank you very much for all the watchers and listeners. Thanks a lot for your questions. And yeah, we wish you, again, depending where you are, a good evening, good afternoon, or a nice day, and hope to speak to you all soon. Goodbye.